Welcome back to the ProTicker Podcast, your Tuesday morning edition covering major financial magazine headlines, everyone. Get ready for an exciting deep dive into today's market movers. We've got tech giants making big moves, global economy shifting gears, and of course, we can't forget about the allure of gold in these uncertain times.
Yeah, it's going to be a fascinating discussion. We'll be looking at everything from Apple's massive investment plans, which the Wall Street Journal is calling a potential game changer, to China's strategic economic shift, described by Bloomberg as trading cheesecake for broccoli.
Okay, so let's kick things off with Apple. They just announced a whopping $500 billion investment in the U.S. over the next 4 years, impacting everything from domestic suppliers to AI and manufacturing.
That's right. And while 500 billion sounds like a huge number, the Wall Street Journal points out that it's actually pretty consistent with Apple's projected spending based on their current financials. So the question is this truly a groundbreaking move, or is it more about optics, especially with President Trump pushing for companies to bring manufacturing back to the U.S.?
Well, considering the potential impact of tariffs, which we'll discuss later, I can see why Apple would want to stay on good terms with the administration. But what's really fascinating to me is the journal's observation about Apple's stock buybacks. Those are consuming a significant chunk of their operating cash, making a true $500 billion new investment seem unlikely without some major changes.
Yeah, you hit on a crucial point. If Apple is truly committed to this level of investment, they might need to reevaluate their stock buyback strategy. It raises questions about their priorities and how they plan to allocate resources in the coming years. And let's not forget the bigger picture here. While other tech giants are pouring billions into AI, Apple seems to be taking a more cautious approach.
So could this be a strategic move to avoid the costly AI arms race, while appeasing both the political landscape and their shareholders? Perhaps they believe they can leverage their existing strengths in hardware and software to maintain their competitive edge without going all in on AI.
That's a very intriguing possibility. It suggests that Apple is betting on a different path to innovation, one that focuses on integrating AI into their existing ecosystem rather than chasing the latest trends. It'll be fascinating to see how this strategy plays out in the long run. Now let's shift our attention to China, where Bloomberg paints a picture of an economy undergoing a significant transformation.
Yes, it's called it a shift from cheesecake to broccoli, which sounds like a pretty drastic dietary change for the world's second largest economy. What exactly does this mean for China, and what are the potential implications for the global market?
Essentially, China is facing some serious economic challenges, rising U.S. tariffs, a struggling property market, and even deflation. But instead of resorting to massive stimulus packages like in the past, they're embracing a more sustainable approach that Bloomberg refers to as creative destruction.
Creative destruction sounds a bit ominous. Can you
That-
explain what that entails?
Imagine it as a strategic pruning of the economic landscape. China is allowing weaker sectors like their overinflated real estate market to shrink while simultaneously fostering competition in high-tech industries like electric vehicles and artificial intelligence. Think of it this way. Less reliance on sugary short-term gains and more focus on long-term sustainable growth.
So while it might be less appealing in the short term, this creative destruction approach could ultimately lead to a healthier and more resilient Chinese economy in the long run.
Precisely. It's about adapting to the changing global landscape and prioritizing industries that are poised for future growth. And it's a stark contrast to what we're seeing in the U.S., where some argue that tariffs might actually be protecting legacy industries and potentially hindering innovation. We see this playing out in the electric vehicle market, for example.
That's a really interesting comparison. While China is actively promoting the growth of its domestic EV industry, the U.S. seems to be more focused on protecting traditional automakers. It raises questions about which approach will ultimately prove more successful in the long run. Now let's head over to Europe, where the recent German election covered extensively by CNBC has shaken up the political landscape.
The victory of the conservative CDU-CSU alliance with Friedrich Merz, likely taking the helm as chancellor, will undoubtedly have significant implications for Germany and the broader Eurozone.
One of the most pressing issues facing the new government is the pressure from President Trump for European allies to increase defense spending, especially in light of the ongoing conflict in Ukraine. CNBC highlights this as a key point of contention between the U.S. and Germany.
Yes, and this is where things get interesting. The far left and far right parties in Germany gained enough seats in the election to potentially block any changes to their strict debt brake rule, which severely limits government borrowing. This creates a major obstacle for Merz if he wants to increase defense spending, which could strain relations with the U.S.
So essentially, he's caught between a rock and a hard place, trying to appease both the U.S. and his own constituents who might not be thrilled about increased military expenditures. It's a classic political dilemma.
Exactly. But there might be a way for Merz to navigate this tricky situation. Bloomberg reports that he could potentially push for a €200 billion emergency defense fund before the new parliament is seated. This could allow him to sidestep the debt brake issue and appease the U.S. without facing immediate backlash from those opposed to increased spending.
That's a clever workaround, and it speaks to the complexity of the situation. Germany is trying to balance its own domestic priorities with its international obligations, all while navigating a rapidly changing geopolitical landscape. Did the markets react to this election news at all?
They certainly did. German bond yields rose and defense stocks rallied, suggesting that investors are anticipating increased defense spending in the near future, regardless of the potential roadblocks. Now let's talk about a safe haven that's been making headlines: gold.
Yes. Gold has been on an absolute tear lately, hitting all-time highs as investors seek refuge from inflation worries and geopolitical instability. It seems like the classic safe haven asset is back in vogue.
Absolutely. And what's even more interesting is that, according to Bloomberg, gold mining stocks are actually outperforming the actual price of gold. Investors seem to be betting on these companies as a leveraged play on the rising gold price, hoping to amplify their returns.
That makes sense. It's like a double down on the gold bet. But is this gold rush sustainable? Are there any factors that could potentially derail its impressive run?
That's the million-dollar question. Well, Goldman Sachs has raised their gold price target to a staggering $3,100, and central banks around the world, including China, are increasing their gold reserves. Some analysts believe that gold's shine could fade.
What could potentially cause that? Is it just a matter of time before this bubble bursts?
Well, several factors could contribute to a decline in gold prices. If U.S. inflation cools down, the Ukraine war comes to a peaceful resolution, or President Trump's tariffs prove less disruptive than anticipated, gold's appeal as a safe haven could diminish.
So as with any investment, there are always risks involved. It's a reminder that diversification is key, and it's essential to consider all sides of the story before making any investment decisions.
Exactly. Let's move on to JP Morgan's warning about investor complacency, which CNBC covered extensively. They suggest that investors might be too optimistic about the U.S. stock market and are underestimating the potential risks posed by President Trump's tariffs.
That's a sobering thought. The S&P 500 has been performing well, but is it sustainable, especially with the added pressure of these trade tensions?
JP Morgan points to a historical precedent. While the S&P 500 initially did well during President Trump's first term, it experienced a significant decline in 2018 as trade tensions escalated. They argue that this pattern could repeat itself if the current trade war intensifies.
So are they suggesting that we should brace ourselves for another market correction?
Not necessarily. JP Morgan acknowledges that the U.S. economy still has the potential for growth and that earnings could outpace other regions. As a result, they're maintaining a neutral stance on U.S. equities for now.
So cautious optimism. It seems like we're in a holding pattern, waiting to see how these trade tensions play out and what impact they'll ultimately have on the market.
Exactly. Let's shift gears now and take a look at Warren Buffett's latest insights. His annual letter to Berkshire Hathaway investors, analyzed in depth by MarketWatch, offers a valuable perspective on the current market landscape.
Buffett is known for his long-term investment approach and his ability to weather market storms. What's his take on the current situation?
Well, one of the most striking revelations from his letter is that Berkshire Hathaway is sitting on a massive pile of cash, over $300 billion to be exact. But despite this, he's not rushing to make any major acquisitions.
That's a lot of cash, even for Buffett. What's he waiting for? Is he seeing any red flags in the market that we might be missing?
It seems so. MarketWatch suggests that Buffett doesn't see any compelling buying opportunities just yet and is likely waiting for a significant market downturn, perhaps even a bear market, before deploying those cash reserves.
That's classic. Buffett patiently waiting for the right moment to strike. It's a reminder that sometimes the best investment strategy is to simply wait for the dust to settle and then make calculated moves.
Absolutely. And this approach is echoed by Bill Smead, a veteran Berkshire watcher quoted in MarketWatch. He predicts that Buffett is anticipating a Noah stock market, a prolonged period of decline. He advises investors to build portfolios that can weather such a storm.
So batten down the hatches and prepare for a potentially rough ride. It seems like we need to be prepared for a range of scenarios, from continued growth to a significant market correction.
Exactly. And one factor that could exacerbate a potential downturn is the looming threat of inflation, which Smead highlights as a serious concern. Inflation could erode the value of cash and make tangible assets like gold even more attractive. But we'll delve deeper into those possibilities in the next segment. While we're on the topic of market uncertainty, MarketWatch has been following an interesting situation with Intel. Their stock has been performing surprisingly well this month, despite operating without a permanent CEO.
Well, that's unusual, isn't it? You'd think a tech giant like Intel would need a strong leader, especially in such a competitive industry.
You would, but their stock is up a remarkable 28% in February alone, even after former CEO Pat Gelsinger's departure back in December. They seem to be managing just fine with an interim executive chair and two interim co-CEOs.
Huh. So is a CEO even necessary? Maybe this unconventional structure is actually working to Intel's advantage.
MarketWatch explored that very question, and that, while there are a few rare examples of companies thriving without a traditional CEO, most experts agree that strong leadership is crucial for long-term success, especially for companies facing strategic challenges like Intel.
Yeah, that makes sense. Maybe this CEO-less structure is effective in the short term, but for navigating the complex landscape of the tech industry, a clear leader at the helm is probably essential.
Think of it like an orchestra. You can have incredibly talented musicians, but without a conductor to guide them, the music might not reach its full potential.
Speaking of navigating complex landscapes, let's circle back to the impact of tariffs, particularly on companies like Tesla.
MarketWatch had an interesting piece on how Tesla's stock recently dipped, despite positive news about a full self-driving software update rollout in China. Are investors overlooking the good news because of bigger concerns?
It seems so. Investors seem more preoccupied with the potential damage to Tesla's brand image due to CEO Elon Musk's involvement with the Department of Government Efficiency. There have even been protests near Tesla showrooms, which could impact sales. Well, that's not a good sign. And to add to the complexity, CNBC reports that Broadcom might be considering a purchase of some Intel assets. That could shake things up even further.
It's definitely a situation with a lot of moving parts. On the one hand, you have Intel stock performing well without a permanent CEO, which hints at potential for growth. On the other hand, there's this looming possibility of Broadcom acquiring valuable Intel assets, which could disrupt their trajectory.
It sounds like a high-stakes game of chess with both Intel and Broadcom making strategic moves. What do you think the impact of a potential acquisition would be on the chip market as a whole?
The implications could be significant, particularly for companies like NVIDIA, who are also vying for dominance in the AI space. Speaking of NVIDIA, MarketWatch provided some insight into what we might expect from their upcoming earnings report.
NVIDIA has been at the heart of the AI boom, and their stock has been on a wild ride. What are analysts predicting for their performance?
There's a lot of anticipation surrounding this report, especially with the emergence of DeepSeek, the Chinese AI powerhouse that's making waves in the industry.
Right. Some analysts are worried that DeepSeek's success could lead to less reliance on hardware in the future, potentially impacting demand for NVIDIA's chips.
That's one perspective. However, other analysts like Mizuho's Jordan Klein, as reported by MarketWatch, remain optimistic. They believe NVIDIA's stock still has room to grow, particularly with the strong demand for their new Blackwell lineup.
So it's a mixed bag of opinions. Some see DeepSeek as a threat, while others believe NVIDIA can maintain its momentum.
Exactly. And adding to the uncertainty is a recent report from TD Cowen, also covered by MarketWatch, suggesting that Microsoft might be canceling some data center leases.
That's a bit concerning. Is this another sign of weakness in the tech sector, or is it just a strategic adjustment on Microsoft's part?
Mizuho's Vikram Malhotra, again cited by MarketWatch, believes it might be the latter. He suggests that this could simply be Microsoft optimizing its operations, not necessarily a sign of trouble.
Well, that's somewhat reassuring. But overall, it seems like there's a lot of uncertainty swirling around the tech sector right now, making it difficult to predict which way the winds will blow.
Indeed. The DeepSeek factor, the ongoing impact of tariffs, and the possibility of a slowing global economy are all contributing to this sense of unease. Let's shift gears now and look at the cryptocurrency market, which is known for its volatility. MarketWatch reported on Bitcoin's recent drop to its lowest point since November.
Cryptocurrencies have had a bumpy ride lately, struggling to maintain the momentum they gained after President Trump's vocal support for the industry. What factors are contributing to this recent downturn?
According to MarketWatch, a few things are at play. There's been some negative press surrounding a $1.4 billion hack of crypto exchange Bybit and a meme coin scandal involving Argentina's president Javier Milei. These events have eroded investor confidence.
Scandals and hacks certainly don't paint a positive picture for the crypto world. It makes sense that investors would be hesitant to jump in, especially given the market's already volatile nature.
And let's not forget the broader economic context. With rising interest rates and a potential slowdown on the horizon, investors tend to become more risk-averse, leading them to pull back from volatile assets like cryptocurrencies.
Right, that's understandable. When uncertainty looms, people naturally gravitate towards safer havens. Which brings us back to gold. It seems like it's been the darling of the markets lately, consistently outperforming other assets.
You're absolutely right. Bloomberg reports that gold is reaching record highs, fueled by those inflation worries and the geopolitical turmoil surrounding the Ukraine war.
And it's remarkable how gold manages to hold its value even during turbulent times. It's like a reassuring constant in a world of fluctuating markets.
It speaks to its enduring reputation as a safe haven asset. And as we discussed earlier, Bloomberg notes that gold mining stocks are actually outperforming the price of gold itself.
So investors are essentially doubling down on gold, betting on both the metal and the companies that mine it.
Precisely. They're looking for a leveraged play on the gold price, hoping to maximize their returns. But as with any investment, it's essential to consider the potential risks. Some analysts believe that if certain conditions change, such as U.S. inflation cooling down or the Ukraine war reaching a resolution, gold's allure could fade.
So while gold is shining brightly right now, its future is far from certain. Speaking of uncertain futures, let's discuss MicroStrategy, the company that's made a bold bet on Bitcoin. MarketWatch covered their recent acquisition spree.
MicroStrategy has significantly increased their Bitcoin holdings, purchasing a massive 20,356 Bitcoins between February 18th and 23rd. This brings their total holdings to almost 500,000 Bitcoins, a staggering amount.
Wow, that's a serious commitment to the cryptocurrency, especially considering its recent volatility. What's driving their strategy? Are they simply following CEO Michael Saylor's lead?
Saylor has been an outspoken advocate for Bitcoin, even going so far as to call for the U.S. to establish a strategic Bitcoin reserve, as reported by MarketWatch. He firmly believes in the long-term potential of Bitcoin despite its current challenges.
It's a bold stance, and it'll be interesting to see how this strategy plays out for MicroStrategy. But for now, let's turn our attention back to the global economy and the potential impact of President Trump's policies. MarketWatch has been analyzing this in detail.
President Trump's presidency has indeed been a roller coaster ride for the markets. His policies, from the tariffs to the Department of Government Efficiency program, have introduced both opportunities and uncertainties.
It's a mixed bag for sure. We've seen tax cuts and deregulation, which have benefited corporations, but we've also witnessed this escalating trade war and growing concerns about a global economic slowdown.
It's a complex web of factors, making it challenging for investors to navigate the current landscape. Adding to this complexity is the recent victory of the conservative CDU-CSU alliance in the German election, as reported by CNBC.
Yes, we discussed that earlier. The election of Friedrich Merz as Germany's new chancellor could have significant implications for Europe's economic and political stability.
Absolutely. Merz is facing pressure from the Trump administration to increase Germany's defense spending. However, as we mentioned, he's also contending with resistance from other political parties due to Germany's strict debt brake rule, which limits government borrowing.
Right, it's a delicate balancing act for Merz. He needs to satisfy the demands of the U.S. while also addressing the concerns of his own constituents.
Precisely. And the outcome of the situation could have ripple effects throughout Europe. If Germany decides to significantly increase its defense budget, it could trigger a chain reaction with other European nations following suit, potentially leading to heightened tensions with Russia.
It's a geopolitical chess match with high stakes. But for now, let's zoom back in on the U.S. economy and those concerns about a potential slowdown. MarketWatch has been highlighting some warning signs.
There are indeed indicators suggesting that the U.S. economy might be losing some steam. We've observed a slowdown in manufacturing activity, a dip in consumer confidence, and a decline in business investment.
Those are all concerning trends. What are economists saying about the likelihood of recession in the near future?
It's a topic of ongoing debate. Some economists downplay the risk of a recession, citing factors like strong consumer spending and a robust labor market. Others are more cautious, pointing to the escalating trade war and the potential for a global economic slowdown to drag down the U.S. economy.
So it's a wait-and-see situation.
Well,
We need more data to determine whether these warning signs are truly indicative of a looming recession.
exactly. The economic data is currently sending mixed signals, making it difficult to predict the future with certainty. However, staying informed and analyzing these trends is crucial for making informed investment decisions.
Right. Knowledge is power when it comes to navigating these uncertain waters.
Hmm.
Now, before we wrap up this segment, let's take a quick look at the bond market, where MarketWatch has observed some interesting activity.
Treasury yields have been declining recently, hitting a 10-week low on Tuesday. This suggests a growing risk aversion among investors who are seeking the relative safety of government bonds amidst the stock market's volatility.
Oh, so it's a classic flight to safety. Investors are essentially parking their money in government bonds until the storm clouds clear.
That's one way to interpret it. When investors are uncertain about the future, they tend to gravitate towards safe haven assets like government bonds, which drives up their prices and pushes down their yields.
It's like a barometer of fear in the markets. The lower the yields, the higher the level of anxiety.
Exactly. And this recent dip in Treasury yields indicates growing concern about the potential for an economic slowdown both domestically and globally.
It seems like all roads lead back to this looming question of an economic slowdown. Will it happen or won't it? It's the million-dollar question on everyone's minds.
Indeed. And unfortunately, there's no crystal ball to tell us the answer. We'll have to carefully monitor the economic data in the coming months to get a clearer picture. However, we can use the information available to us now to make informed decisions and prepare for potential challenges.
That's a great point. It's all about being proactive and adaptable in these uncertain times. Now let's move on to our final segment for today. We'll be diving deep into the world of European finance, where the aftershocks of the German election are beginning to be felt. We'll analyze what the conservative victory means for Germany's economic policies, its relationship with the U.S., and the future of the Eurozone.
Welcome back. As promised, let's turn our attention to Europe, specifically Germany, where the recent election has sent ripples through the financial world.
Right, and CNBC provided some excellent coverage of the election and its potential ramifications. The victory of the conservative CDU-CSU alliance, led by Friedrich Merz, could have significant implications for Germany's economy, its role in the Eurozone, and its relationship with the United States.
Yeah, you're spot on. Merz is known for his fiscal conservatism, so he'll likely prioritize balanced budgets and fiscal responsibility.
So could this signal a shift towards less government spending and potentially slower economic growth in the short term?
It's certainly possible. However, it's a delicate balancing act. Excessive austerity could stifle growth and potentially lead to social unrest. Merz will need to find a way to balance fiscal prudence with the need for investments in crucial areas like infrastructure and education.
And what about Germany's relationship with the U.S.? President Trump has been quite vocal about his desire for European allies to increase their defense spending. How is Merz likely to respond to that pressure, especially considering Germany's strict debt brake rule?
That's the million-dollar question. Merz has indicated a willingness to increase defense spending, but as we discussed earlier, he's facing resistance from other political parties due to Germany's debt brake rule, which limits government borrowing.
So he's essentially caught between a rock and a hard place, trying to appease both the U.S. and his own constituents, who might be wary of increased military spending.
Precisely. It's a classic political dilemma. However, one potential solution, as reported by Bloomberg, is that Merz could attempt to bypass the debt brake issue by establishing a dedicated emergency fund for defense spending, potentially reaching 200 billion euros.
Okay, that's a clever workaround. But even if he manages to secure those funds, won't it potentially create friction within the Eurozone? Other countries might not be too happy about Germany flexing its financial muscle.
That's a valid concern. Germany is the economic powerhouse of Europe, and its actions inevitably impact the entire Eurozone. If Germany starts spending more liberally, it could pressure other countries to follow suit, potentially leading to economic instability within the bloc.
Right. It highlights the interconnectedness of the Eurozone and the delicate balance that needs to be maintained. With the added pressure from the U.S. and the uncertainty of President Trump's America First policies, it's definitely a time of great change and uncertainty for Germany and Europe as a whole.
Absolutely. It's a dynamic situation that requires careful analysis and adaptation. Staying informed about these global trends and understanding the various perspectives is more important than ever.
And that's why we do what we do here on the Pro Ticker Podcast. We strive to equip our listeners with the knowledge and insights they need to navigate the complexities of the financial world.
We aim to be your guide through the market maze, helping you make sense of the forces that shape the global economy.
Well said. We've covered a lot of ground today, from Apple's investment plans to China's economic shift from the German election to the latest developments in the gold and cryptocurrency markets.
It's been a whirlwind tour of the financial landscape, but we hope you found it informative and engaging.
Remember, the markets are constantly evolving, so staying curious and engaged is key. We'll see you all tomorrow morning with new headlines from major financial magazines.